Hello, everybody. In my last two lecture series for the capital market part 1 and part 2, we have discussed about the concept of the financial market, the capital market, and the various intricacies which actually revolves around the capital market. Now, what does the capital market actually do? And what is the concept of a capital market with the contrast with the money market and with the versus the bank loans? So, in order to understand the nuances and various intricacies of a capital market, it is very important to understand also that the part 1 and the part 2 series of the capital market have given you a kind of a fundamental base of understanding the capital market itself. So, if you in this series, in this 31st lecture series, and the thing is this that I have tried to concentrate. I will try to concentrate and confine myself to some of the very important areas which actually revolves around the capital market. And the very important thing is this, that how the kind of various instruments which actually revolve around the capital market. And very important thing is to also understand that whether the composition of the capital market with the bank loans are also very important. Normal bank lending is not usually classed as a capital market transaction, even when the loans are extended for a period longer than a year. First, these banks loans are not securitized, and securitized means they are not packaged into a resellable security like a share or bond that can be traded on the markets. Second, the lending by the bank is more heavily regulated than the capital market lending. Now, thus the third, the bank depositories tend to be most more risk averse than capital market investors, and these three differences all act to limit the institutional lending as a source of finance. Now, two additional differences this time favoring lending by banks are that the banks are more accessible for small and medium sized companies, as they have the ability to create money as they lend. In the 20th century, most company finance apart from share issues were raised by bank loans. So, but since about 1980, there has been an ongoing trend for intermediation, where large and credit-worthy companies have found they effectively have to pay out the less interest if they borrow directly from the capital markets rather than from banks. Now, the tendency for companies to borrow from capital market instead of banks have been especially strong in the United States, because according to Financial Times, the capital market overtook bank lending as the leading source for the long-term finance in the 2009. So, you after going through this paragraph, you'll be able to understand that capital market has diversified in such a way that it has overtaken the banking loan segment. Actually, where in banking, the long-term finance in 2009, which reflects the risk aversion and the banking regulation due to 2008 financial crisis. Now, compared to the United States, companies in the European Union have a greater reliance on the bank lending for funding. Efforts to enable the companies to raise more funding through the capital markets are being coordinated through the EU Capital Market Union initiative. Now, what are the examples on the governments in the primary market? So, first we will look into the various aspects of the role of government or a regulator in the capital market, because this is very important to understand that what the government feels on the primary market. We have told you earlier that capital market is divided into two segments. One is primary market, another one is a secondary market. So, what the government's roles in the primary market? In this lecture series, you will be able to find the overall view or the global picture of the capital market. Now, we will, after the discussion of this global picture of the capital market, we will try to concentrate on our Indian perspective also, because the main birth of this capital market is from the US. So, without understanding the US capital market, it is very difficult for us in order to understand the Indian perspective also, because Indian capital market has just thrived the 30 years or 40 years back, but the US capital market is there prevalent for the last 70-80 years, and they are doing very well also. Sorry. So, when a government want to raise a long-term finance, it will often sell the bonds in the capital market. In the early 21st centuries, many governments would use investment banks to organize the sale of their bonds. The lending bank would underwrite the bonds and would often head up the syndicate of brokers, some of whom might be based off in other investment banks. Now, the syndicate would then sell to various investors. For developing countries, a multinational bank would sometimes provide an additional layer of underwriting, resulting in the risk being shared between the investment banks and multinational organization and the end of the investors. However, since 1997, it has been increasingly common for the governments for the larger nations to bypass the investment banks by making their bonds directly available for the purchase online. Many governments actually now sell most of their bonds by computerized auction. Typically, large volumes are put for sale in one go. A government may also hold some number of auctions each year. Now, some governments will also sell a continuous stream of bonds through the other channels. The biggest single seller of the debt in the US government, there are usually several transactions for such sales for every second. Now, which actually correspond to the continuous updating of the US real-time debt clock. So this is kind of a concept of the government on the primary market. We will try to concentrate on our next lecture series about the company on the primary markets, so how the company have got a perspective on the role of the primary markets in our next lecture series. Thank you very much for joining.